Module 2, the World Bank Group and how a multilateral development bank is financed. 5 institutions, the difference between the hard and the soft window, how any development bank raises the money it lends, and who controls it. The World Bank Group was created at the Bretton Woods Conference in 1944 and is headquartered in Washington, D.C. It is 5 legally separate institutions under one president. The IBRD, the International Bank for Reconstruction and Development, founded in 1944. It lends to governments of middle-income and creditworthy lower-income countries on near-market terms. IDA, the International Development Association, founded in 1960. This is the concessional window, credits at very low or zero interest with long maturities and grace periods and outright grants for the world's lowest-income countries. The IFC, the International Finance Corporation, founded in 1956, lends to and invests equity in private companies. No sovereign guarantee. MIGA, the Multilateral Investment Guarantee Agency, founded in 1988, provides political risk insurance and credit enhancement. And ICSID, founded in 1966, handles conciliation and arbitration of investment disputes. It finances nothing and hires no development consultants. Know it so the acronym does not confuse you. The World Bank means IBRD and IDA together. The World Bank Group means all 5. When a colleague says the bank, establish which. The International Monetary Fund shares the Bretton Woods origin and sits across the street, but it does not finance projects. It lends to correct balance of payments problems, and it conducts macroeconomic surveillance. It matters to your work indirectly and powerfully. An IMF program sets ceilings on how much a government may borrow and on which terms, which determines what a development bank can lend and what a ministry can spend. Debt sustainability analysis, done jointly by the bank and the fund, is what decides whether a country receives IDA grants or IDA credits. This is the single most useful mechanism in the course because it explains why the banks behave as they do. Every regional bank works the same way. Member governments subscribe capital. A small fraction is paid in as cash. The large majority is callable capital, a legally binding commitment to pay if the bank ever needs it to meet obligations to bondholders. It has never been called at the major development banks. That capital base, plus the credit standing of the shareholder governments, gives the bank a top credit rating. The bank then issues bonds in international capital markets at very low cost and lends the proceeds to borrowing governments at a modest spread. This is the non-concessional window, IBRD, at the World Bank, ordinary capital resources at the regional banks. Repayments flow back, and net income is recycled into new lending. Concessional windows work on an entirely different model. IDA, the African Development Fund and the Asian Development Fund, cannot be funded from bond issuance because their terms are too soft to service debt. They are funded by donor replenishments. Every 3 years, provider governments negotiate a package of contributions, together with reflows from past credits and transfers from the bank's own net income. IDA has additionally borrowed against its equity in capital markets since 2018, a hybrid model the other funds have studied. The practical consequence is direct. The hard window's lending capacity is limited by capital adequacy and rating. The soft window's is limited by donor politics. A replenishment round that goes badly shrinks the pipeline in the poorest countries 2 to 3 years later. A general capital increase expands lending in the middle-income ones. Shareholding is proportional to subscribed capital, and voting follows shareholding. The United States is the largest shareholder in the World Bank and holds enough votes to block decisions requiring a supermajority. Every development bank has the same architecture. A board of governors, usually finance ministers, meeting annually. A resident board of executive directors that approves every loan and the procurement rules. And management, which prepares operations. By long-standing convention, the World Bank president is nominated by the United States, and the IMF managing director by a European country. The regional banks follow their own conventions, generally reserving the presidency for a national of the region. 2 things follow for a consultant. First, the World Bank sets the standard the rest of the system copies. Its procurement framework, its environmental and social framework, its results and evaluation practice, and its project documentation are the reference model for most regional banks and many bilateral agencies. Learning one institution deeply and learning this one transfers further than learning any other. Second, every project produces a public document trail. The concept note, the project appraisal document, the environmental and social documents, the procurement plan, the implementation status reports, and the implementation completion and results report. Read in sequence. These tell you the stage, the borrower, the executing agency, the financing amount and instrument, and the consultancy packages planned. Also worth holding, concessionality. Two loans of identical size can differ enormously in value to the borrower. Concessionality is the gap between market terms and the terms actually offered, a lower rate, a longer maturity, a grace period before principal repayment begins. That gap is the aid inside the loan. Before you rely on any of this, check the source. Membership counts, shareholding percentages, IDA eligibility lists, lending terms, and replenishment sizes all change. Use World Bank. Org for institutional structure and country eligibility, the current IDA replenishment report for the concessional package, and the bank's annual report and financial statements for capital and lending volumes. In summary, 5 institutions, IBRD, lends to middle-income governments, IDA is the concessional window for the poorest, IFC finances the private sector, MIGA ensures political risk, ICSID arbitrates disputes. The IMF is separate and macroeconomic, but its judgments gate what the banks can lend. Hard windows are financed by shareholder capital and bond issuance. Soft windows by 3 yearly donor replenishments. Voting follows capital. Next, the regional development banks of Africa and Asia Pacific.